Hello everyone, welcome again to our channel. We hope you had a wonderful week. In our last lesson we explored how we can use trade payables and good relationships with suppliers to operate a business with no initial cash. Today we'll take a brief look at another powerful financing method, borrowings or simply loans. Loans are one of the most common ways businesses finance their operations. They can come from banks or through bonds, overdrafts or other financial instruments. But to keep things simple, we'll focus on the classic bank loans. Imagine we again want to buy apples. We have checked all our resources, hidden supplies and even went through our pockets. But we realize we have no money. We talk to our supplier, but the supplier can't extend more credit. What can we do? We decide to borrow money. The easiest way to borrow money is from the bank, a secure and well-guarded institution which normally has a lot of funds and could support you in need. You pay a visit to a bank and find out that money from the bank will cost you extra money. Yes, loans typically come with an interest. The longer you keep the money, the more interest will be calculated on it and the more you will need to pay back. But for now, we'll ignore the interest topic and focus on the accounting logic. Let's assume we get an interest-free offer. We rush to get the funds as our customer doesn't want to wait, and thanks to our good financial reputation and solid turnover history, the bank agrees to lend us $50. Now we have a liability to the bank. How do we reflect it on the balance sheet? To reflect the bank loan, we introduce a new item on our balance sheet. We call it loans. Now our balance sheet looks as follows. Assets 0, and in the liabilities we now have loans of $50 and the total equity and liabilities are $50. And the balance sheet doesn't balance. Oh, there's never balance in balance sheet. But we know the trick already, right? Let's quickly fix it. We now have cash from the bank. So we record it as cash, which is one-to-one reflects the liability to the bank, as we haven't spent anything yet. And the balance sheet balances. Now time to go shopping. Let's spend all money we have and make our customer very happy by getting him all the apples in the world. We reach out to our supplier and get 5 apples from him, $10 each. Stable prices? Great news, let's rock! We take our apples and record them on the balance sheet in the usual place, as inventory. Now we have $50 in inventory and $50 in loans, with no cash on the balance sheet. Our assets, our inventory, is fully financed by third parties, by a bank. The balance sheet balances, what a dream! We cannot keep inventory forever and the customer is waiting, so we will sell the apples as soon as possible. But because the customer is extremely impatient and really wants our apples, we can earn some profit on them. We sell apples now for $12 each and get $60 from our customer, all in cash, immediate payment. Now our balance sheet is: in the assets, no inventory, cash of $60 and total assets $60. In the liabilities we have loans of $50, totaling $50. So the balance sheet doesn't balance. Where are the missing $10? It's the profit from selling $50 worth of apples for $60. Those $10 belong to us, so we record it onto equity. Well done, profits are always good. An updated balance sheet will look as follows. In the assets we have cash of $60 and total assets are also $60. In the liabilities we now have equity of $10 and loans of $50, totaling to $60. It balances again. So now we have cash enough to fully repay our loan and close our liability. So we go to our bank and happily repay our debts. Bank is happy, we have not disappointed. We are happy, we no longer owe money to anyone. We repay the $50 loan using part of our cash, decreasing both parts of our balance sheet by 50. Our contract with the bank is fully fulfilled. Our balance sheet looks like this. Cash $10, total assets also $10. Equity $10, loans now 0, total equity and liabilities $10. The loan is repaid and we still have $10 in profit. And the balance sheet balances. Yeah, it's all good, but in real life, loans aren't for free. You must pay interest. The longer you use the loan, the more you would need to pay back. So, before taking a loan, a business must consider, will the profit from the transaction exceed the cost of borrowing? And even if there is no immediate profit, will it maintain customer satisfaction and lead to future gains? Sometimes, the value of keeping a loyal customer outweighs short-term financial cost. So, today we took an extra step into the sources of finance in the business and kept our balance sheet in equilibrium through different steps. What would be our key takeaways for the lesson? Loans are another way to finance business operations. Borrowed cash should be recorded as a separate liability, loans, and not mixed with the payables. Profits go into equity. Always compare the cost of the loan with the expected profit. Loans can help bridge gaps when supplier credit isn't available. Thanks to everyone for watching our new video. We hope you enjoyed learning about loans and they can help you to run and grow your business. Don't forget, like, subscribe and hit the bell icon so you don't miss our next lesson. See you soon!